Hello everyone, and welcome back to Collin Investing. Today we're diving deep into a complex, rapidly evolving land, the intersection of US economic policy, shifting market trends, and of course the strategies you need to navigate it all. Imagine you are building a portfolio, and you are trying to predict where to place your investments. What do you need to analyze? Exactly. We need to know what is going on with economic policies and current market movements, and that's precisely what we'll be exploring. Recent economic shifts, the ripple effects across various markets, and the potential opportunities and risks that are emerging for investors like you and me. We're going to unpack a lot today, from Trump's proposed tax cuts to the fascinating dynamics in the AI chip market, so buckle up, it's going to be an insightful ride. We will explore the investment opportunities and potential risks. Let's jump right in. So, we've set the stage with a broad overview of the economic landscape. Now, let's zoom in on one of the most significant and potentially disruptive proposals on the table. Trump's tax cut plan. This isn't just a minor tweak, it's a sweeping overhaul with far-reaching implications for businesses, investors, and the economy as a whole. The House Budget Committee has given its initial blessing to a budget resolution, and at its heart is a massive $4.5 trillion tax cut spread out over the next decade. Think of it as a potential turbocharge for corporate earnings, but with some significant strings attached. The core idea is to build upon the foundation of the 2017 tax code, extending those provisions and in many cases sweetening the deal even further. We're talking about expanded tax breaks across the board. But, and this is a crucial but, it's not just about cutting taxes. Here is a parallel push to slash spending. The current proposal aims for $1.5 trillion in cuts, and here is a strong faction within the Republican Party pushing for even deeper cuts, protecting what's known as mandatory spending. We're talking about the big-ticketed items, healthcare, Social Security, and other social safety net programs. This is where the political battles will be fought, and the outcomes will directly impact millions of Americans. So get around potential roadblocks in the Senate. The plan is to use a process called budget reconciliation. This allows them to pass the bill with a simple majority, bypassing the need for Democratic support. It's a procedural maneuver, but one with huge consequences. Now, for us as investors, there are several key policy considerations to keep a close eye on. First, the proposed changes to corporate taxes. We're potentially looking at a 15% rate for domestic manufacturing, a significant drop that could boost profits and influence investment. Second, here is the capital gains tax. The proposal is to lower the long-term rate from 20 to 15%. This, if that comes into play, will certainly boost the market by bringing in more funds. And finally, there is the potential for an increase in the SALT cap, the deduction for state and local taxes. This could free up more disposable income, particularly in high-tax states. These are all moving parts, and the final shape of the tax package will depend on intense negotiations and political maneuvering. But one thing is clear: the stakes are incredibly high, and we need to be prepared for any outcome. So, we've talked about the grand vision of this $4.5 trillion tax cut, a potential boon for businesses and investors. But, as with any major policy shift, the devil is in the details, and the path to actually implementing this is riddled with challenges and uncertainties. It's like trying to assemble a massive jigsaw puzzle while the pieces are constantly shifting. First off, we have a classic Washington, D.C. showdown brewing, a disagreement between the House and the Senate. Think of it as two chefs in the same kitchen, each with their own recipe for the same dish. The Senate, it seems, isn't entirely on board with the House's all-in-one approach. They're planning to address tax reform separate, potentially in a piecemeal fashion. This immediately creates friction and raises the question of whether a cohesive, comprehensive tax package can even emerge, but the internal divisions don't stop there. Even within Trump's own economic team, there are conflicting views. It's like a tug-of-war over the timing, a debate about when to cut taxes versus when to cut spending. Some argue for immediate tax cuts to stimulate the economy, while others are adamant about prioritizing spending cuts to address the ballooning deficit. This internal conflict adds another layer of complexity and unpredictability. And speaking of that deficit, it's the elephant in the room. The U.S. is already grappling with higher deficits, and Trump's ambitious tax cut proposals, coupled with his other demands, could make the situation even more challenging. This in turn makes it harder to get the necessary votes to pass the reform, creating a kind of vicious cycle now. You might be thinking, okay, but what's the immediate impact on the market? Interestingly, right now, the market seems more preoccupied with Trump's tariff policies. Those are the headlines grabbing attention: the immediate threat of trade wars and their potential consequences. However, and this is a key tail envy, as the details of the tax reform proposal become clearer, and as the legislative battle heats up, expect the market's focus to shift. The potential impact of tax reform, whether positive or negative, will likely become much more significant as the policy takes shape. So keep your eyes peeled. This is a story that's just beginning to unfold. So, we've seen the potential roadblocks and political wrangling around these massive tax reforms. But what's actually happening right now? In the markets? Where is the smart money flowing? Well, let's take a look. And the picture is quite revealing. Imagine a seesaw. On one side, you have the US stock market, long considered the powerhouse, the go-to destination for investors. But surprisingly, for the first time in 10 months, we've seen 2 consecutive weeks of money flowing out of US equities. It's not a massive exodus, but it's a significant shift, a tremor that's worth paying attention to. And here is that money going? A good chunk of it, a hefty $4.1 billion to be precise, is fleeing the technology sector. Think of it as investors hitting the pause button on their tech enthusiasm, at least for the moment. It's like the party music has been turned down a notch, and many people are moving off the main dance floor. Meanwhile, across the Atlantic, something quite different is happening. European equities are suddenly the belle of the ball, attracting a substantial inflow of $2.5 billion. It's as if investors are rediscovering the charm of the old world, seeking refuge or perhaps new opportunities in markets that have been relatively overlooked. And then here is the explosive growth in Hong Kong. The Hang Seng Index is up over 15% year to date. It is a remarkable surge. Now, Bank of America has a compelling explanation for all of this. It is investor positioning milm. Simply put, many investors were overweight in US equities and tech and underweight in international stocks. It's a classic case of Rebound, a recalibration of portfolios to reflect changing perceptions of risk and reward. We were heavily positioned in US equities, and now we are seeking new and exciting horizons. So we've observed this intriguing shift in capital flows, money moving out of US tech and into other areas. But what does this really mean for us as investors? Are we on the brink of a major market downturn? Should we all be panicking and selling everything? Not so fast. The overall picture is one of caution. Yes, but definitely not pessimism. Think of it like a ship adjusting its course slightly in response to changing winds. Rather than heading straight into a storm now, you might be thinking, okay, but what about this tech stock pullback? Isn't that a bad sign for the future of AI? And that's a perfectly valid question. Here is the key. This recent dip, this slight retreat in tech stocks, doesn't invalidate the long-term investment thesis for artificial intelligence. In fact, I'd argue the opposite. Consider a situation where you are offered a discount for your favorite item. It's potentially a buying opportunity for those of you who have been following the AI revolution closely. And I know many of you have. You know that this technology is good. It's not going away. Short-term market fluctuations don't change that fundamental reality. Of course, there are other investment themes swirling around out there. You've got the Trump trade, those investments tied to his policies. You've got the potential for a resurgence in China. And you've got the value hunters looking for bargains in Europe. But, and this is important, these are generally shorter term and much more volatile plays. They're like riding a roller coaster, exciting maybe, but also potentially stomach-churning. On the other hand, remains a dominant long-term investment theme. It's the bedrock, it's the underlying current that's reshaping industries. So, the strategy here, in my view, is to focus on buying quality AI leads, the companies with strong fundamentals, proven track records, and the ability to weather these short-term storms. And when do you buy them? During these market dips, these moments of temporary weakness. That's when you can potentially get the best value for your investment. We are not abandoning AI. We are doubling down on it strategically and thoughtfully. This is not just about surviving the current market conditions. It's about thriving in the long run. So, we've seen the broader market dynamics at play, the shifting sands of capital flows. Now, let's drill down into a specific, highly contested battleground, the AI chip market. This is where the future of computing power is being forged, and the fight is between custom-designed CHED XCOS and the reigning champion, the GPU primarily dominated by NVIDIA. Imagine you're building a high-performance race car. You could use a general-purpose engine, powerful, versatile, but maybe not perfectly orchestrated for every twist and turn of the track. Or you could design a custom engine specifically built for that, one a race, that one a track, maximizing every ounce of power and efficiency. That's the basic premise behind custom chips, or XCOX, in the AI world. They're designed for very particular tasks, like running specific AI models, and in those narrow applications, they can offer some compelling advantages. The market is showing optimism about custom chips for 3 main reasons. Think of them like this. First, higher performance and efficiency, and that's a crucial. but only in very specific applications. If it does not apply to those apps, it is a big zero second, the initial hardware cost. This is where it gets interesting. A custom chip can be significantly cheaper than, say, Nevada IDEA's flagship H100, which can cost upwards of $20,000. We're talking, in some cases, about hardware costs of just $3,000 for certain XCOX. That's a massive difference, and it's catching the attention of big players. Third, and this is what's fueling a lot of the hype. You have tech giants like Meta and Google already deploying these custom chips in their own cloud platforms. This creates a narrative that everyone is going to ditch GPUs and flock to XCOX. It's a powerful story, and it's had a real impact on the market. And this is where we need to be discerning investors. That's not the whole story. A recent and, I would say, very conservative report from Morgan Stanley argues that the market is seriously overestimating the threat of XCOX to the dominance of GPUs. They're essentially saying, hold on, pump the brakes, let's look at the full picture. And they break it down into three key areas. First, system architecture. It's not just about the individual chip, it's about how all the pieces fit together. NVIDIA has this incredibly powerful technology called Inslee Inc., a high-speed interconnect that lets BPUs talk to each other with blazing speed. Custom chips often rely on optical interconnects, which can be much more expensive, driving up the overall cost of building a data center. And then, tier is high bandwidth memory. HBM, another crucial component, because NVIDIA produces GPUs in such massive volume, they can negotiate better prices for HBM, giving them a cost advantage. Custom chip makers, with their smaller scale, don't have that same leverage. Second, we have software and hardware compatibility. This is where NVIDIA's FUDE ecosystem comes into play. It's a mature, battle-tested software platform that developers have been using for 15 years. It's like the operating system of the AI world. Custom chips, on the other hand, often require a lot of extra work. Developers have to spend weeks, sometimes months, adapting their software to run on these new chips. That's time, money, and resources that many companies simply don't have. Finally, here's the question of long-term support and maintenance. Think of it like buying a car. Do you want a car from a well-established manufacturer with a global network of service centers, or a niche brand with limited support? NVIDIA has built a vast ecosystem around its TPUs, providing ongoing support, updates, and a whole community of developers. Many custom chip vendors simply can't match that level of long-term commitment. So, while the initial price tag of an XCOX might be tempting, the total cost of onboarding, considering all these facts, can be significantly higher. The conclusion: don't count out GPUs just yet. So we've established that while custom chips do have a niche, the narrative of them completely displacing BPUs might be a bit overblown. But you might be asking, okay, Collin, but why is NVIDIA so confident? What gives them the seemingly unshakable position? Well, it's what we in the business call a moat, a deep, wide defensive barrier protecting their castle. And NVIDIA's moat is formidable. Now first, and this is a staggering number, $16 billion in R&D investment. Let that sink in for a moment. That's more than the entire GDP of some small countries. Most custom chip vendors, they're playing in a completely different league. This massive investment allows NVIDIA to maintain a relentless pace of innovation, staying several steps ahead of the competition. Imagine you are racing, and you have way more resources than anyone else. Second, it's not just about the individual chips. NVIDIA offers a comprehensive AI infrastructure. We're talking about all the compute power, the storage, the networking, the software, all working together. It's like buying a perfectly integrated high-performance ecosystem, rather than trying to piece together components from different vendors. Think of it as the difference between buying a pre-built top-of-the-line gaming PC versus trying to assemble one yourself from scratch. Sure, you might be able to save a few bucks, but the headaches and compatibility issues can be a nightmare. Third, Nevada IDEA has product diversity. They offer a wide range of GPUs, tailored to different needs and budgets. It's like having a toolbox filled with specialized tools rather than just one all-purpose hammer. This flexibility allows them to cater to a vast array of customers, from small snotties to massive enterprises. Custom chips, by their very nature, are less flexible. If your needs change, you might be stuck with a solution that's no longer optimal. Morgan Stanley's core view, and I strongly agree with this, is that GPUs and custom chips will coexist. It's not an either-or situation, but, and this is the crucial point, GPUs will maintain their dominance in the core AI market, the heavy lifting of AI training and development. NVIDIA isn't standing still, And we should always remember this. They have the resources and the expertise to adapt the GPU architecture to make them even more efficient and competitive. Potentially recapturing might have gained a temporary foothold. Hello everyone, and welcome back to Collin Investing. And finally, the linchpin of it all. FUDA. This is NVIDIA's secret weapon. They're not just selling chips, they're selling a system elm. The CUDA ecosystem, with 15 years of development behind it, is a massive advantage. It's the industry standard. Developers are familiar with it, they're comfortable with it, and they've built countless applications on top of it. That's a level of lock-in that's incredibly difficult for competitors to overcome. So, while the custom chip narrative is interesting, don't underestimate the power of NVIDIA's deeply entrenched moat. So we've established NVIDIA's powerful position, its impressive moat. But let's not paint an unrealistic picture of total unchallenged dominance. The reality, as Morgan Stanley and I see it, is coexistence. This brings us to an interesting nuance, a key aspect to grasp for the astute investor. It's not about GPUs versus ASICs, it is about them both. Think of it like a diverse ecosystem, each creature finding its niche, custom chips, those XCOCs, to have a genuine advantage in one crucial area: energy efficiency during inference. Inference is the everyday use of an AI mod. Think of it like a trained dog performing tricks, as opposed to the intensive training process itself. If you are running a massive data center, processing millions of requests every second, that efficiency adds up big time. And there's almost always a but, right? GPUs, the workhorses, retain their clear advantage in the training phase. Training these AI models is like teaching that dog. In the first place, it requires immense computational power, the kind of raw horsepower that GPUs are designed for. So, it is more efficient to use GPUs there. Consider a scenario where you use highly specified tools in different processes, and the advantage is clear. And the scale, that is where we will see changes. What's going to happen, and what we're already starting to see, is the scale of custom chips used in inference growing. It's like a rising tide. As the overall AI market expands, so too will the demand for these specialized, energy-efficient chips. They have their room, they have their place. They will grow, and they will expand. In the end, both technologies can complement each other. It's a symbiotic relationship, not a zero-sum game. Understanding this dynamic is key to making informed investment decisions in the AI chip space. Let's take a moment to recap the major market movements from this past week, ending the 15th of February, 2025. It's like taking a snapshot of the overall health and direction of the financial world, and this week's picture is quite telling. We saw a broad rebound in U.S. equities. The Nasdaq led the charge with a robust gain of 2.58%, followed by the S&P 500, up 1.47%, and the Dow Jones Industrial Average, which rose by a more modest 0.55%. The upward trajectory paints a picture of renewed investor confidence, at least for the time being. Breaking it down further, it's clear that technology stocks were the stars of the show. The tech sector as a whole surged by 3.76%, indicating a strong resurgence in this previously volatile area. Investors seem to be shaking off some of their earlier jitters and returning to the growth potential of tech. In the bond market, we witnessed a slight decrease in the 10-year Treasury yield, settling at 4.48%. This suggests a somewhat more stable outlook for interest rates, although the market remains highly sensitive to any hints of change from the Federal Reserve. Turning to commodities, oil prices experienced a slight dip, with West Texas Intermediate, WTI, crude closing at $70.49 a barrel. This minor fluctuation reflects the ongoing balancing act between supply, demand, and geopolitical uncertainties in the energy market. Meanwhile, the US dollar weakened by 1.2%. This decline can be seen as a reflection of various factors, including shifting expectations about interest rates and the ongoing discussions surrounding potential tariffs. In the volatile world of Kikots, Pagdung saw a slight increase. It is a reminder that digital assets remain a significant, albeit unpredictable, part of the financial landscape. Finally, gold, often considered a safe haven asset, had a roller coaster week. It initially hit a new high, suggesting heightened investor anxiety, but then retreated to around $2,882 per ounce. This pullback might indicate that some of that initial fear has subsided, at least for now. So, we painted a picture of the overall market's rebound, but what were the driving forces behind those numbers? What were the headlines, the whispers, the events that truly moved the needle this week? Well, two things dominated the conversation: Trump's ongoing tariff pause, the ever-present will he or won't he, and of course, the crucial inflation data. Imagine you are playing a game of chess. And these are the two major pieces in play now, the CPI and PPI nungs. Those are your consumer and producer price indexes. For those less familiar, they came in hot, higher than expected. This initially sparked some anxiety. Are we seeing a resurgence of inflation? Is the Fed going to have to slam on the brakes harder? But, and this is where it gets intriguing, the PCE, the Personal Consumption Expenditures Price Index, that's the Fed's preferred gauge, the one they watch most closely. It showed continued disinflation. It's like two conflicting signals, creating a sense of uncertainty, but also a glimmer of hope that inflation is, indeed, still trending in the right direction. Beyond the macro picture, we had some stellar individual stock performances. Apple surging 7.5%, and NVIDIA, not far behind, up 6.9%. These tech giants were flexing their muscles. And why? Well, for Apple, a major catalyst was this AI collaboration with Alibaba in China. It's a signal that Apple is serious about expanding its AI footprint in one of the world's largest markets. This partnership, combined with Apple's move to introduce AI features in China, significantly boosted market confidence, and the results are obvious. Then, here is the rumor mill, always churning. We heard whispers of a potential massive AI server deal between Dell and Elon Musk's XAI. $50 billion are involved in the deal. Now, this is still unconfirmed, but it speaks to the voracious demand for AI infrastructure. And finally, we saw some strong earnings reports from companies like Upstart and AppLovin, further evidence that the AI-driven growth story is far from over, despite those broader market fluctuations we discussed earlier. So even with a backdrop of economic uncertainty, specific companies, particularly those leveraging AI, are still finding ways to shine. So, we've seen some strong individual stock performances, particularly in the tech sector, hinting at a resurgence of AI-driven growth. But remember, individual companies don't operate in a vacuum. They're influenced by the broader economic currents, the ebb and flow of data releases and policy decisions. And that brings us to the crucial calendar of upcoming macro events for the week of the 19th of February 2025. These are the dates to circle, the events that could trigger market volatility or, conversely, reinforce the current trends. First, a brief respite. Monday is Washington's birthday, so the U.S. markets will be closed. Enjoy the long weekend, but be prepared for a flurry of activity when trading resumes. Tuesday kicks things off with a trio of data points. We'll get the New York State manufacturing data, a pulse check on the health of the industrial sector in that region. Then we have the Developer Confidence Index, a gauge of sentiment in the housing market, which, as you know, is a crucial component of the overall economy. And to round out the day, we'll hear from the San Francisco Fed president. Now, any comments from Fed officials, particularly regarding inflation or interest rate policy, can send ripples through the market, so pay close attention to the tone and the specific language used. Wednesday is arguably the busiest day of the week. We'll get data on housing starts and building permits, two more key indicators of the housing market's strength or lack thereof. Remember that a robust housing market is often seen as a sign of overall economic health, while weakness can signal broader concerns. But the main event on Wednesday, without a doubt, is the release of the FOMC minutes. This is where we get a glimpse into the inner workings of the Federal Reserve's decision-making process. Analysts will be scrutinizing every word, every phrase for clues about the Fed's future policy path. Are they leaning more hawkish, concerned about inflation, or dovish, more focused on supporting growth? The market's reaction could be significant. Thursday brings us the usual suspects: initial jobless claims, a weekly snapshot of the labor market's health, and the Philadelphia Fed Manufacturing Survey, another regional indicator of industrial activity. We'll also hear from the Chicago Fed president, adding another voice to the chorus of Fed commentary. And, importantly, we'll get the U.S. leading economic indicator, a composite index designed to predict future economic trends. This will give us a broader, more forward-looking perspective. Finally, Friday rounds out the week with a series of releases. We'll have the S&P US Manufacturing and Services PMI, yet another gauge of business activity, providing a comprehensive view of both the manufacturing and service sectors. Then we get the Michigan Consumer Sentiment Index, a crucial measure of how consumers are feeling about the economy. Are they optimistic and ready to spend, or are they pulling back and saving? This is a key indicator of future economic activity. We'll also get existing home sales data, another piece of the housing market puzzle. And to cap it all off, we'll hear from the Fed Vice Chair. This is a high-ranking official, and their words carry significant weight, so expect the market to be listening intently. So, mark your canas. It's going to be an information-packed week. Beyond the macroeconomic forces and the broad market indicators, individual company performance is, of course, crucial. And that brings us to the earnings reports, those windows into the financial health of specific businesses. The earnings season is like a report card for the companies, and we want to examine them carefully. We've got a packed calendar of earnings releases coming up in the week of the 19th of February 2025, and these announcements could inject some significant volatility, or perhaps even reinforce existing trends into the market. Let's go day by day. First off, on Tuesday before the market opens, we have Baidu, the Chinese search giant. Given the renewed interest in the Chinese tech sector, this report will be closely watched for clues about the overall health of that market and Baidu's AI initiatives. Then, later on Tuesday, after the closing bell, we hear from Occidental Petroleum. This will be key for understanding the energy sector's performance and any potential impact from those fluctuating oil prices we discussed. Wednesday, before the market gets going, see reports. We need to keep a close eye on this one. Thursday is the big day. Before trading starts, we get earnings from two behemoths, Alibaba and Walmart. Alibaba, like Baidu, will be a barometer for Chinese tech and consumer spending. Walmart, on the other hand, is a bellwether for the U.S. consumer, a crucial indicator of overall economic health. These two reports, released simultaneously, could set the tone for the entire day, and perhaps even the week. Consider a scenario where both give out positive earnings. What a boost to the market! Finally, on Thursday, after the market closes, we have Block and Rivian. Block's results will be interesting to see how fintech is evolving. Rivian will give us a pulse on the electric vehicle market, a sector that's been experiencing both rapid growth and intense competition. So there you have it, a full slate of potential market movers. Be sure to mark your calendars, and remember to analyze not just the numbers themselves, but also the context, the management commentary, the forward guidance, and the overall sentiment. It's good to pay attention to these. So, we've been looking at the giants of the AI chip market, NVIDIA, and the rising challenge of custom chips. But the tech world is never static, is it? There are always new deals, new partnerships, and sometimes potential mergers that can reshape the entire landscape. And that's where this intriguing rumor about TSMC and Intel comes into play. Consider a scenario where two major tech companies are getting together. What are the implications? Let's dive in. We're hearing whispers, and at this point they are just whispers of a potential joint venture between TSMC, the undisputed king of chip manufacturing, and Intel, the American giant that's been trying to regain its footing in the chip race. The purported goal? To bolster U.S. chip manufacturing capacity. A direct response to the growing concerns about relying too heavily on overseas production. It's a guerre del chess move as much as it is a business deal. The possible scenario being floated is this: Intel spins off its manufacturing division, essentially separating the design of chips from the actual making of them. Then TSM steps in, providing its unparalleled expertise and, crucially, its advanced process technologies. It's like Intel saying, we're good at designing, but you're the best at building, so let's team up. But, and this is a big but, here's where the questions start to arise. From TSMC's perspective, the strategic value of this deal isn't exactly crystal clear. Why? Because TSMC and Intel, while both in the chip business, operate on fundamentally different business models and, importantly, utilize different process technologies. Intel's existing equipment, much of it, is geared toward manufacturing less advanced chips, not the cutting-edge stuff that TSMC is focused on. TSMC is pouring its resources into expanding its 2-nanometer capabilities. Acquiring Intel's manufacturing division in its current state might be like buying a factory filled with outdated machinery. Sure, you get the building, but you still need to invest heavily in upgrading the equipment, retraining the workforce, and integrating everything into TSMC's existing operations. That's time, money, and a whole lot of effort. Then here is the issue of independence. TSMC's entire business strategy, its reputation, has been built on being a neutral player. They work with everyone known, from Apple to AMD, without favoring any particular customer. A deep partnership with Intel, a direct competitor to many of TSMC's clients, could seriously jeopardize that neutrality. It's like a referee suddenly joining one of the team. It raises all sorts of red flags, and the most critical issue, the core technologies. Remember TSMC's cutting-edge processes, those are proprietary. They're the secret sauce, the crown jewels, that give TSMC its competitive edge. If they're entering into a joint venture with a competitor, how do they protect that intellectual property? Do they restrict Intel executives and engineers from accessing certain parts of the facility? Does that even make sense? If it's a joint venture, wouldn't both partners have a say? And if TSMC were to transfer or somehow share this technology with its competitor, is it not watering down its strength? There is also a bigger problem ahead. Given the dominant market positions of both TSMC and Intel, any kind of significant collaboration is almost guaranteed to trigger antitrust scrutiny. It's like two giants murder regulators, both in the US and potentially internationally, are going to take a very close look to make sure it doesn't create an unfair monopoly, even if the current administration doesn't raise a fuss. What about the next one? What if the political winds shift? The risk of a forced breakup down the line is very real. So, what's the bottom line here? Right now, it's simply too early to assess the true impact on TSMC's stock. We need way more details. Is this a limited partnership with TSMC firmly in control? Or is it a full-blown merger of manufacturing operations? The devil, as always, is in the details. And until those details emerge, any speculation is just that, speculation. We need to track how this goes. From the complex world of chip manufacturing, let's shift gears to a different but equally fascinating frontier: robotics. And this is where two tech titans, Meta and Tesla, are about to clash. It's a battle of innovation, vision, and ultimately the future of work. Imagine a world where robots basing integrate into our daily lives, handling tasks that are frankly either tedious, dangerous, or just plain boring. That is the world both of these companies want to bring Meta. The company formerly known as Facebook is making a major push into humanoid robotics. This isn't a side project, it's a significant investment, a strategic pivot powered by artificial intelligence. They're envisioning robots that can perform a wide range of humanoid tasks, from simple chores to complex operations. And to lead this charge, they brought in some serious firepower. Meta's team will be led by the former CEO of General Motors' autonomous driving division. This is a clear signal. Meta is serious, and they're bringing in top-tier talent to make this happen. The initial focus, interestingly, is on the home. Think of robots that can help with housework, everyday tasks that many of us would gladly offload. But the ambition doesn't stop there. Meta's long-term vision is much grander: to manufacture and sell robots to a variety of businesses, providing the underlying ABO, the brains, the sensors, the software that powers these machines. Now this should sound very familiar, because it's essentially the same playbook as Tesla's Optimus robot. We're talking about bipedal, autonomous humanoid robots that walk on two legs, navigate their environment, and perform tasks that are either unsafe for humans, repetitive, or just not very enjoyable. It's a head-to-head competition, a race to build the most capable, versatile, and ultimately useful robot. The stakes are incredibly high, and the implications for the future of work are profound. So we've been talking about Meta and Tesla's foray into the robotics world, a fascinating clash of titans. But let's pivot back for a moment to the ever-unfolding drama surrounding NVIDIA, the undisputed heavyweight champion of the AI chip market. Remember that massive moat we discussed: the R&D investment, the CUDA ecosystem, the sheer dominance. Well, this week brought some interesting developments that are worth dissecting. Revealed through NVIDIA's 13F report, essentially a peek into their investment portfolio. First, the broad strokes. NVIDIA's stock was up 2.6% this week, but let's be clear and direct. This is no breakthrough. Not yet. It's still trading within that established range, and the real test will come with their upcoming earnings report. However, what's caught everyone's attention is that 13F. It shows a significant reshuffling of their holdings, and it sent ripples through the market. It's like watching a chess grandmaster make a series of unexpected moves. You know, here is a strategy, but you are trying to decipher it. Two names in particular stand out: SOUN and TEM. NVIDIA completely cleared their positions in both. Gone zero. And that's had immediate and frankly brutal consequences, especially for SOUN. The stock plummeted, and I really mean plummeted 28% on this news. Now, for those of you following SOUN, or perhaps caught in that downdraft, let's talk technicals. The next strong support level, the place where it might find some footing, is way down between $7.6 and $8.2. That's a considerable distance from where it's currently trading, a stark reminder of the volatility in these high-growth speculative plays. We are not just talking about a dip. This is a major revaluation of the company's prospects, at least in the short term. This should make you think. I talked about the inherent risk before, and this is one real example. Then here is DIM. This one hasn't crashed, yet, but the same principle applies. NVIDIA didn't completely exit their DIM position, but it's worth noting the context, the shifting sentiment surrounding these smaller, less established AI-related companies. But then, from a purely technical standpoint, the strong support zone, the area to watch, is between $66.4 and $72.2. Again, a substantial drop from its current levels. These are not minor adjustments, they are significant shifts in valuation. So, what's the takeaway from all of this? NVIDIA's 13F moves, coupled with the market's reaction, are telling us something important. They're reinforcing that while the overall story is still very much intact, the long-term potential is undeniable. Here is a growing sense of caution, perhaps even skepticism surrounding some of the smaller, more speculative players. It's a reminder that in this rapidly evolving landscape, discernment is key. It's not enough to just ride the AI wave. You need to be incredibly selective about which waves you choose to surf. Let's shift our focus now, because amidst all this talk of AI chips, market fluctuations, and tax cuts, here is another potentially massive development brewing, one that could fundamentally alter the way the US government interacts with the financial markets. We're talking about Trump's proposed sovereign wealth fund. Now, the idea of a sovereign wealth fund isn't new. Countries like Norway, China, and Singapore have been using them for years, essentially. They're state-owned investment funds, pools of money used to invest in various assets, from stocks and bonds to real estate and, yes, even companies. But the use having one that's uncharted territory, and it raises some very interesting questions. Trump signed an executive order. The plan to set this up within the next 12 months, and one of the first potential targets, interestingly enough, is TikTok. Remember all the controversy surrounding that company? Well, this fund could be the mechanism for the US government to acquire it, or at least a significant stake in it. Imagine that, your government owning one of those applications. But here is the crucial difference. Most countries that have these funds, they have them because they have a surplus. They're making more money than they're spending. The US, as we all know, is in a very different situation. We're running a massive fiscal deficit. So, the immediate question, and it's a big one, is here, is this money going to come from? The initial funding source is still unclear. Some have suggested using revenue generated from those tariffs we talked about earlier. Others have floated the idea of debt issuance, essentially borrowing money to invest. Consider this for a situation. The government is going deeper into debt by borrowing money and use it to make more money. That's a high-stakes gamble, to say the least. The stated goal, the official line, is to generate investment income, to create a stream of revenue that would, in theory, reduce the government's reliance on debt. It's like trying to pay off your credit card by investing in the stock market, potentially lucrative, but also potentially disastrous if things go south. We need extra income, and this is what the government comes up with. But here is where it gets even more interesting, and perhaps a bit concerning. This fund, if structured in a certain way, could effectively bypass the Federal Reserve. It could conduct its own form of quantitative easing, buying up assets, injecting liquidity into the market, but without the Fed's direct involvement. It's like creating a parallel financial system, controlled directly by the executive branch. And that leads us to the biggest risk of all: increased government spending reliance on investment returns. What happens if the fund performs poorly? Will there be pressure to take bigger risks, to chase higher returns? Will the government become increasingly dependent on the stock market's performance to fund its operations? These are crucial questions, and the answers will have profound implications for the US economy and for all of us as investors. It's a fascinating, complex, and potentially game-changing development, one we'll be watching very, very closely. And that brings us to the end of today's deep dive into the markets, the policies, and the ever-evolving world of AI. I truly hope you found this breakdown insightful and helpful as you navigate your own investment journey. But the conversation doesn't end here. I want to hear from you. What are your thoughts on Trump's proposed sovereign wealth fund? Do you see it as a stroke of genius, a risky gamble, or something in between? What about the ongoing battle in the AI chip market? Are you Team NVIDIA, Team Custom Chips, or are you taking a more diversified approach? Jump into the comments below and let's get a discussion going. I am genuinely curious to hear your perspectives, your strategies, and, yes, even your disagreements. Remember, the best way to learn and grow as investors is to share our knowledge, our insights, and our experiences. So please, take a moment to leave a comment. Share your investment strategies for the current market. Are you playing it safe? Are you taking calculated risks? Or are you going all in on a particular sector? Let's learn from each other. And, of course, if you found this video valuable, please give it a thumbs up. It really helps the channel grow and reach more people who are passionate about finance and economics. And if you haven't already, hit that subscribe button and ring the notification bell so you don't miss out on future deep dives, analyses, and market updates. Finally, share this presentation with others that are interested in finance and economics. Thank you, as always, for your time, your attention, and your engagement. Until next time, stay informed, stay strategic, and stay invested. This is Collin, signing off.